taxes is pretty much on everyone's mind, or at least should be, going into retirement, mainly because of what you mentioned. We're in a historically very low tax bracket environment. And so it's very likely that everyone watching this video today, at some point in time in your retirement years, your taxes are going to increase. I think it's also important to understand, what you own when it comes to retirement types of accounts, which of those accounts are taxable, which of those are tax-free, and then ideally to find out which accounts you can consolidate, because as you get closer to retirement, you want to consolidate as much as possible. You want to keep things as simple as possible. One of the ways you do that is by consolidating the types of accounts that you can. Some people mistake diversification for saying, I own 5 different IRAs. Well, you don't need 5 different IRAs to be diversified. You could combine all 5 of those IRAs into one and diversify in there. That's a way just to keep it simple. So when we think about the types of investment accounts out there in the world of investments and taxes, I'm going to start by just saying there's really only 2 types of taxable accounts when it relates to taxes. There's a thing called non-qualified accounts, and there are qualified accounts. So everyone watching this video today, if you have any investment accounts at all, I don't care if it's at an insurance company, I don't care if it's at a bank, I don't care if it's at a brokerage firm, those assets either are non-qualified or qualified. And what I like to use is an analogy of an umbrella. If you have a qualified account, you have an umbrella that covers your investments, and we know that an umbrella protects us from rain, but in this case, we're going to talk about taxes. So if you have a qualified account, that means you have an account that is protected from taxes as long as it stays underneath that umbrella. If you have a non-qualified account, that means you don't have an umbrella. That means you're going to get every year a 1099. If you earn interest, if you earn, if there's any return on your investments, any capital gains, there's no umbrella to protect it. So if you have a bank account, a trust account, a personal brokerage account, a joint account, anything like that, your investments, you could own XYZ mutual fund out here, and every year there's a return, you're going to pay a tax bill on that investment. If you're saving for retirement, it's generally better not to have a non-qualified account, to move it into a qualified account. A qualified account simply means that your taxes are deferred. So we're talking about qualified accounts. We're talking about things like a 401k, most of us are familiar with. We're talking about IRA. Let's throw up here Roth IRA. And I'll just throw one more up here, 403b. There's all types of what I'll call umbrellas, 403bs, 457s, thrift savings plans, anything like that. All that is just an umbrella that covers your investments. Sometimes people ask me and they say, which is better, a 401k or an IRA? And the answer to that question is there's no such thing. All they are is an umbrella. Your rate of return is not based on whether it's a 401k or an IRA. Your rate of return is based on what you own in the portfolio. I could own XYZ mutual fund out here and pay tax on it every year. I could own XYZ in my 401k, my IRA, my Roth IRA, and my 403b. So the rate of return is based on this, not this. A 401k earns 0%. An IRA earns 0%. A Roth IRA doesn't perform better than an IRA. That's no such thing. What your rate of return and your performance is always based on this. So let's say you have a retirement account, you have a 401k, you have an IRA, you're not getting a tax bill on it every year. That means it's a qualified account. One of these days when you pull the money out from this umbrella, how many of you believe it is going to rain? Yeah, it is getting ready to rain. So as long as it stays under here, there's no tax. But one of these days when you pull the money out, that's when you pay tax. After age 59 and a half is generally when you take money out of this umbrella and not have any penalties. Right now, they've raised the age for required minimum distributions, but if you have too much money in these umbrellas at age 73 this year, the government requires you to take out a certain minimum distribution, and that's because you owe taxes on these things. So as you plan for retirement, you look at this and say, if I have a 401k and I want to open up an IRA, I can open up another umbrella over here. And as long as it's the same type of umbrella, I can move my money from a 401k, and instead of having XYZ mutual fund over here, I can buy ABC annuity. If I move my money from this umbrella to this umbrella, and they're the same type of umbrella accounts, there is no tax. I can move the money from my 401k to my IRA and not pay tax on that rollover. But when I take the money out of the IRA, that's when I'm going to pay tax. So I first want to say, sometimes people get scared. Hey, if I take the money out of the 401k, I'm going to pay tax. That's true if the money goes from your 401k to your bank account. If the money goes directly from your 401k to an IRA, there is no tax. I can move money from one IRA to another IRA. There's reasons why we might consider this. I might have 5 IRAs and I only want one. I can consolidate this. Taxes are not the issue. So from a tax standpoint, we need to understand to see which ones we can consolidate, which ones we can't. I'm going to show you one other example today. There is something up here that is qualified, which means tax deferred. After it's tax deferred, you're either going to pay tax on it, or when you pull the money out, there is no tax. In a Roth IRA, when I pull the money out of a Roth IRA, there is no tax. As long as I've had that account for 5 years, I'm 59 and a half. There is no tax. A Roth IRA, the earnings are 100% income tax free as long as I've held it for 5 years and 59 and a half. One more thing I want to talk about today, and that is because, Marvin, we talk a lot about taxes and concerns. People can, contribute to Roth 401ks, they contribute to Roth IRAs. But what if the majority of my money is in an IRA, a traditional IRA or traditional 401k? Is it possible to take money from 401k or an IRA and get it into a Roth IRA? The answer to that question is yes. I would open up an umbrella over here. It's a Roth IRA, okay? But it might look a little bit different than this umbrella. So since it's not exactly the same, when I take the money from this umbrella to this umbrella, I'm gonna pay tax now. There's tax on the way over, but when you take money out of the Roth IRA later, it is 100% income tax free. This is not all or nothing. If I have $500,000 in my 401k or an IRA, I could take $50,000 a year, put it into my Roth IRA for 10 years. It doesn't have to be all or nothing. You can do it little by little, and you make that decision, that termination based on what is my tax rate, what is my tax bill, do I have enough money in non-qualified accounts to pay the tax. So in other words, for the purpose of this call today, we want all of our clients, we want all of you to identify what types of accounts do you own. Is it non-qualified, you get a tax bill on it every year, or is it qualified, you don't? And ideally, we want to move the ball down the field. We want to move from a taxable account to a tax-deferred account to a tax-free account if possible. But this is something, Marvin, people should not do on their own. You definitely want to make sure if you're going to do a rollover, you're working with a qualified professional and make sure there is no tax on the rollover or tax on the transfer. And then it's just easy to tell everybody, yeah, throw it all in Roth IRAs. You're going to get a major tax bill. There's going to be a problem when it comes to Medicare premiums if someone does that. So again, all these things need to be done with the help of a financial planner like we do, but there is a way to do it. And that's the main thing to know today. And so we can help people move that taxable accounts from taxable to tax deferred to tax free.